Hey everybody, welcome back to the show. Today we've got another edition of 5 Question Friday where I do my best to answer questions that you have sent in. If you'd like to send me a question, the best way to do it is to subscribe to the newsletter. It's free, it goes out every Sunday morning. There's a link below this video where you can sign up, and in that newsletter there'll be a link to a form where you can submit questions. So grab your coffee, let's get started. Let me show you what we're going to do. Actually, I've got some bonuses for you today. We're actually going to cover 6 questions, and a viewer sent in a free investment tracking spreadsheet that might even be better than the one I have talked about in the past, better than mine. Can you believe that? Maybe. I'm going to show that to you at the end. All right, so here are the questions. Do I ever send out a Facebook friend request? That's the bonus question. We're going to start off with that one. But then also, is it a good time to start investing? Is rebalancing in volatile times just market timing? If you follow the 4% rule, how should you factor in taxes? Should an emergency fund be part of your asset allocation? And then my opinion on T-bills, those are short-term U.S. government bonds, as compared to, say, CDs or other types of bonds. Great question. And then we'll get to the investment tracking tool. So let's get started. This bonus question, I included it because it's so important. Here was the actual question. Do you send Facebook friend requests? I received one and believe it is a scam. So I don't send Facebook friend requests to my friends. I don't send them to my family. My kids make fun of how few friends I have on Facebook. I haven't sent a Facebook friend request in years. So, but this is important. There's a lot of scammers out there that target YouTube channels, and we do our best to sort of delete spam comments and all that sort of thing, but it's frankly impossible to keep up with. So I'm not trying to reach out to you. I'm not trying to call you. I'm not giving you my phone number or WhatsApp number. I'm not friend requesting you. I'm not doing any of those things. And most importantly, I'm not trying to sell you something. I don't have some investment that I'm trying to sell you. So if you're seeing that from someone that's pretending to be me, that is a scam. So please ignore it. Let's be safe out there. So there you go. Great question. All right. What's next? Is it a good time to start investing? And I thought this was a really important question to cover right now because things are not calm, right? We're always living in uncertain times, but sometimes they feel more uncertain than others with the tariffs and the wild swings in the stock market. And then there's always the questions about, are we going to go into recession? What about U.S. government debt? That's always sort of a cloud hanging over us, the interest payments that we have to make on that debt. All of these things, are scary. And so I actually think it makes the perfect time to start investing. In fact, the truth is, I think the best time to invest is yesterday, or maybe 20 years ago. But the second best time to invest is today. The thing about investing in times when the market seems scary is you're going to need experience dealing with scary markets. If you invest for the long term, you're going to encounter market after market after market that's scary, right? We can go back in time and think of the market during COVID or the market during the great, financial recession, crisis, banking, property value, subprime mortgages. Remember all that from 07, 08, 09, or the tech bubble bursting in 2000. We can just keep going on and on. There are always going to be scary times in the market. The thing about starting to invest during a scary time is that, at least I would think for most of you, you're investing relatively small amounts of money. And so you get the benefit of the experience of dealing with a very volatile market without risking a lot of money. Now, I would still say it's a good time to invest even if you had a lot of money to start with. But I'm guessing most folks getting started, you're making some amount of a 401k contribution out of your paycheck, or you're opening up an IRA or maybe a taxable account and sort of putting in a little bit of money each payday. I think volatile times, you should really kind of see that as a blessing because you get to watch what happens. And you're going to have really bad days in the market, and you're going to have really good ones. We had a really good market just 2 days ago. It was one of the best in decades, but it followed some really bad days. And then, of course, the day after, yesterday, it went down. We'll see what happens today. But yes, I think today is a wonderful time to start investing. And you should actually embrace the fact that things are so uncertain in the world right now, because you're going to get wonderful experience dealing with that while not risking, a lot of money. Now, the day will come if you keep investing where you'll go through scary markets with a lot more money, but hopefully by then, your other financial arrangements are in good shape. You're not overextended with a lot of debt. You've got an emergency fund, so you have other things in place that can help you, be secure financially when you go through those difficult markets. But now, getting started, yes, I think now is an excellent time to get started investing. Great question. All right. The next question is rebalancing in volatile times just market timing? And they say, and as markets fall, should I sell some bonds to buy stocks 15 years from retirement? So here's my take on this. If you have a rebalancing plan that you stick to, then I don't think it's market timing. So for example, if you're going to rebalance once a year, and let's just say it's now, you just decided around tax time, you're going to rebalance the second Monday of April every year or whatever it might be. But it just so happens that we're in that time period now and the markets are going crazy. Is that market timing? I don't think it is, because you're following a plan. You're not rebalancing because of what's going on in the market. You're just rebalancing because it happens to be, I'm just making up a date, the second Monday of April. And that's when you rebalance, every year. Or maybe you rebalance when your allocation gets out of whack by a certain amount. It deviates from your plan by X percent. And maybe you decide, I'll check my portfolio once a month or once a quarter. And if it's deviated by whatever the percent you've decided, then you'll rebalance. Again, the market may be going crazy when you do that rebalancing, but you're just following your plan. So I don't believe that's market timing at all. And that's basically what I do. I rebalance based on when it deviates from my plan by a certain amount. And if that happens, I just rebalance. And as the viewer asked, we'll go back to it. Yes, that means that sometimes you're selling bonds to buy stocks. If stocks are down and bonds are either up or maybe flat, then rebalancing, if you were, say, at 80% stocks, that was your plan, and now they're down to whatever, 75%, you would sell fixed income, if that's in your portfolio, to bring your stocks back up to 80%. If they've dropped to 75, that means your fixed income, and maybe you combine some cash in there as well, have gone from what you planned, 20% up to 25. So you would absolutely sell some bonds or fixed income to buy stocks. And of course, the reverse could be true. If stocks have gone up, sometimes you sell stocks to buy fixed income to rebalance. That's exactly what you do. So great question. Next one. This is a tricky one. I'm going to tell you that right now. I struggled with this one. If following the 4% rule, should the amount you pay in taxes be included in that? And then the next question is the tricky part, even if doing Roth conversion. So just a quick refresher, the 4% rule, Bill Bengen was the author of a 1994 paper where he did some back testing, went back to 1926 and looked at 30-year retirements. And he said, in the worst scenario we've ever had going back to 1926, it happened to be for retirees who retired in the mid 1960s, they could take out 4% of their portfolio in year one of retirement. So let's say you've got $1 million, 4% is 40 grand. They could then, in year two, adjust that 40,000 by the rate of inflation and keep doing that every year. So you start with 4% for year one, then you throw that percentage out. It's got nothing to do, it just gets the ball rolling. In year two, you just adjust for inflation. And assuming you're invested somewhere between 50 and 75% in stocks and the rest in U.S. Treasury bonds, your money will last at least 30 years. Again, 4% was the worst case scenario. That happened to be for people that retired around 1966. By the way, if you retired in like 1982 or 3, after 30 years, you wouldn't have $1 million. You'd have about $5 million. So it's very extreme. There were some periods where you could have started your initial withdrawal rate at 10% and not run out of money after 30 years. But the worst case scenario, mid-60s, you had to go with 4%. Now, in that paper, he doesn't really talk about taxes. He doesn't talk about investment fees either, by the way. But in subsequent papers he did. Frankly, I find his approach in subsequent papers to be a little confusing, where he talks about different withdrawal rates depending on the account type. The way I like to think about it is simply taxes are just another expense. You can take out your 4%, and some of it's going to go to utilities, some of it's going to go for groceries, some of it's going to go to Uncle Sam. So that means if you want to think about your withdrawal on an after-tax basis, I mean, I suppose we could think about it on an after-utilities basis. We don't typically do that. But if we wanted to think about it on an after-tax basis, we'll have the most if we pull out of a Roth, because we get all 40 grand. We're going to have the least if we pull out of a traditional retirement account. If we just assume our total tax rate's 25%, we'd have $30,000 left over after taxes. And if we took out of a taxable account, it depends on our cost basis in the investment, so it's going to vary, but be somewhere in between. And there could be years where you take a little bit out of each account type. So it can get kind of confusing, but I kind of view the tax part of it as just another bill that we have to pay, and it doesn't change the 4%. Now, Roth conversions get trickier. So let's imagine you've got $1 million. You say, okay, I'm going to follow the 4% rule. I've just retired. I'm going to take my $40,000 out. But then you think, I'm also going to do a Roth conversion. I'm going to convert some of this. And let's just, for sake of argument, let's say before you took your $40,000 out, you decided to convert all $1 million. I know it's unrealistic, but it'll make a point. So if we pay 25%, that's 250 grand. And so now we've got $750,000 in a Roth. If we then say, okay, I did the conversion now. I remember that 40,000 I calculated. I'm going to take 40,000 out of my 750. Well, we're already over 4%. We've exceeded 4%. And I think one could argue that you can still use 4%, but you should do the conversion first and then calculate your 4%. Now, if you do that, it turns out that the after-tax result is the same whether you convert or not, right? Because if you've got $1 million, that gets you $40,000. You got to pay taxes on it if it's coming out of a traditional, say, IRA. 25%, that's 10 grand. You're left with $30,000 after tax. Now, what if we convert all that first to $750,000? We've paid our taxes, and we apply 4% to $750,000. Guess what that number is? It's $30,000. It's the same number as you'd get on an after-tax basis if you applied the 4% to the full million. But that doesn't really answer the viewer's question, because I'm assuming that you convert everything at one time and that we're talking about your first year of retirement where we're applying this 4% rule. What if you're in year 3 of retirement? You've been adjusting your withdrawals by the rate of inflation. You started at 4%, but then starting in year 2, you just adjust for the rate of inflation, and you're not going to convert everything. You're going to convert 25,000 or 50,000. Now it gets much more complicated. I think in many cases, if the tax liability is relatively small, it probably just doesn't matter. Remember, 4% is the worst case scenario, but it also depends on exactly how you're investing your money. Are you paying investment fees or not? There are a lot of other factors. And that's why I've ultimately concluded that while the 4% rule is a great rule of thumb for sort of planning purposes, as a practical matter, probably not the best way to actually think about your withdrawals once you retire. If you've got a situation that's involved enough to be doing Roth conversions, frankly, I would use retirement planning software to figure out whether my overall plan, including my withdrawal amounts and which accounts they're coming from, and Roth conversions that I'm doing, does it make sense? Does it have a good chance of success? And for that, I would either use Bolden or Projection Lab. Those are my two favorite. I'll leave links to both of them below the video. But great question, and not an easy one. At least it wasn't easy for me. All right, this one's easier. Should an emergency fund be part of your asset allocation, or is it special, and why? So the way I think about it is I include my emergency fund as part of my asset allocation. It's part of my fixed income. I do that because this is not money I plan to spend. This is money that's going to just stay there, hopefully forever. But if I need it for an emergency, then I'll fill it back up. And so I just think it makes sense to include it as part of your fixed income. Now, depending on the amount of the emergency fund and your overall portfolio, it may not be a significant part. It might be a very small percentage. But yeah, I do include it as fixed income. What I don't include in my asset allocation is money that I plan to spend over the next 6 to 12 months. So we've got money set aside to pay Uncle Sam, which is coming due here in a couple of days, and some work we're going to do on the house. So I don't include that in our asset allocation. But I think it makes sense to include money from an emergency fund as part of the asset allocation, because that's going to be there in one form or another, indefinitely. So yeah, that's my approach anyway. I include it. All right. The last question before we get to the investment tracking tool: what is your opinion of using T-bills for cash instead of CDs or other bonds? The Treasury website is a bit clunky, but state tax it's state tax free is a plus. So I really like T-bills as a place to hold cash. I don't buy them through Treasury Direct. That website is clunky. You can just buy them through your broker, Fidelity, Vanguard, Schwab, wherever you keep your money. That's where I buy them. I buy them through the broker, so I don't have to deal with the website. They are state and local tax free. Of course, other Treasury bonds are as well, but of course, corporate bonds wouldn't be. Municipal bonds, of course, are free of federal income tax, may be free of some state income tax, depending on where you live and the bond you hold. But yeah, I think T-bills are excellent. In addition to not buying them from Treasury Direct, the other option, let me show you this, is you could use a fund. I own shares of this fund. It's SGov is the ticker. I'm not recommending this for you. You'll want to do your due diligence. But it's inexpensive. The expense ratio is only 9 basis points. And if we look at the holdings, it's just all T-bills. Here we go. You can actually see what this fund owns. This is just a convenient way. If you don't want to go in and buy individual groups of T-bills, you could just use a fund like this. And I find it to be a very easy way to hold my cash. So that's what we do. All right, great question. Now, the last one is a viewer sent in a link to a Boglehead forum posting. I'll show it to you now. Where, and I don't know this user, but they just posted it. Tracker Dan. But anyway, he apparently has made an investment tracking spreadsheet. Longtime viewers know that I have one. I tried to update it to a version 2.0, which I think was sort of I'm not sure how if that really improved it. But in any event, this one, I haven't used it yet, but I took a quick look at it. So if you click, let me go back. If you click this link right here, make a copy, it allows you to make a copy in Google Sheets. And so I did that. I'll do it again here. So this is the spreadsheet. I've not used it, but when I looked at how it was set up, that looks pretty nice. I like it. Obviously, it's got some demo data that Dan, who created this, has in here for you. But you'd clear that out, of course, and put your own information in. I haven't to rebalance 1 and 9. So there's a rebalancing aspect of this. I've not dived into deeply, but it's got allocation here. I guess this difference it's triggered a rebalancing maybe for tips. It's got a holdings page, and then account setup where you can list your accounts, and an asset setup. So again, I've not used it yet, but I'm going to use it. But it looked good enough that I wanted to share it with you. So maybe if this is better than my investment tracking spreadsheet, I'm good with that. I want you guys to have the best tools that are out there. And so check this one out. I'll leave a link to the Boglehead forum posting, so you can check that out if you want to. Whew. Well, that's it. That's it for 5 Question Friday, which turned out to be 6 questions plus a free tool Friday. But hopefully you found all this info useful. If you have any questions, maybe you think I got an answer wrong. I mean, that happens from time to time. Leave all that in the comments. Please try to be friendly, but I appreciate that. And if you have questions, let me know. Just leave them in the comments below. Be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.